The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. Welcome, everyone, to this week's episode of the Fed15 podcast, presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that feds need to know in 15 minutes or less. So whether you're a seasoned federal employee deep in your career or whether you are just starting out as a Fed, Fed15 has got you covered. So grab your coffee, grab your tea. I've been into Earl Grey lately. Kick back, and we will tell you what you need to know but might have missed in the federal space this week. We are your hosts. I am Katelyn Murray, and I am joined by the wonderful Dan Sipe.
How you doing, Katelyn?
I'm doing well.
Oh, cracking out the Earl Grey, the preferred choice of one Jean-Luc Picard.
100% Earl Grey, hot. But my kettle doesn't operate itself just yet, so still working on that, I guess. Yeah, I've been doing really well. This is like peak summer season, very much like my favorite season. Technically my favorite season is fall, but a lot of the hobbies that I like to do are in the summer, obviously pool time, kayaking, big into kayaking, hiking. So been having a really good time just kind of running wild here in Southern Virginia. Yeah.
You say that, I immediately think of Donnie from the Wild Thornberrys.
I mean, not far off
Nice.
from that. Work hard, play hard for sure.
Yes.
But definitely. So speaking of the pool, I had a very unique experience this past week. I went to a floating sound bath. Have you heard of this?
I have not.
It is very cool.
Open.
Yes, it is very cool. So basically, we had these like floats, but they were like basically blow up mattresses, I think is what they were, because they were really thick floats. And we all got in the pool and we got onto our little mattress and we laid flat and we floated around the pool while they played like gongs and rain sticks and like the singing bowls and like the drum. It was very hippy dippy, very ooey wooey, but it was pretty relaxing, which I think is the point, to just kind of decompress, relax, and just kind of space out for a little bit. So it was a lot of fun.
Wow.
I'd never done that before.
Yeah, that sounds more relaxing than goat yoga.
Yes. Yeah, I think. Although I think they give you beer with goat yoga. So maybe, I don't know. Maybe 6 of 1.
Although I have a niece who's a yoga instructor, and she's kind of worked at pioneering alpaca yoga.
Alpaca yoga.
Yes. And what she shared with us is that the alpacas, when they settle down with you, they hum.
Oh,
it kind of sounds kind of epic, actually, So,
yeah.
And of course, there's baby alpacas. So, baby anythings are pretty cute. So
yeah, that's adorable. I guess it's like the equivalent of a cat's purr, maybe.
Yeah, but floating sound bath. Interesting.
Yeah. Yes. So that, I mean, for our folks who don't love the sports reviews and content at the top, that's probably about as far removed from sports as you can get. Floating sound bath.
Absolutely. And I'm very proud of myself that I brought in something like alpaca yoga, so I was able to contribute.
Yeah. Yeah.
I'm growing as a person.
We're getting better and better at our cold opens. However, I think we do have some interesting. Dan Sipe wrote a very good TSP article that I definitely want to make sure we spend some time on today. And then we also had another article on our benefits bin column also on TSP. So looking at Roth TSP option and catch up for those who are over 50. Yeah. But talk to us a little bit, Dan, on how we can boost our TSP balance and your concept of the January jump. I love that
Absolutely.
concept.
Absolutely. One of the great things about, having done something for almost 40 years is you get to see the things that work and the things that don't. But you also get to see what gets missed. And sometimes some things that don't appear large, when you miss them, they kind of have a cumulative impact that is not in your best interest. But when you don't miss them, they have a pretty strong cumulative impact that is in your best interest. So one of the things, and I know I'm a nerd with this, one of the things is periodically the tax code allows for increases into qualified defined contribution retirement plans. Okay, so that's about as nerdy as I can get on that. Well, that's TSP, folks. For all of us here in Fed World, that's TSP. And so for instance, Katelyn, did you know that since January 1st of 2000, that contribution limit has been increased 16 times. So it's not quite every year, but it's fairly frequent. And usually on average is about $500 or $1,000. So, it doesn't seem like a lot if it's in that glide path. Now that's just for the base contribution. There also is the catch-up provision, which we'll be talking about in the second half of this podcast. But that's where if you're over a certain age, you can add additional money or catch up. That was introduced in 2002, and that has been increased 8 times over that same period. So one of the things that we've seen, and Katelyn, I know you bump into this too, where we'll meet somebody through our webinars, they sign up for our part 2, and one of the first things we point out is, did you know that you're not contributing up to the maximum for TSP? And what I've seen a lot is that people are a little bit surprised and go, wait a minute, I remember I set that up a couple of years ago and I was at the max. Yes, you were. But sometimes this gets lost in the noise. So what I'm suggesting, and I call it January jump, is sort of do a little habit stacking to put you in a position so that you know when you can increase it and you actually do it. Because all too many times we meet feds who didn't and maybe miss a couple in a row, and that really becomes impactful. But for all the people that are there going, come on, Dan, $1,000, what, I'll catch it up later. Yeah, okay, yeah, that's kind of true. However, because I'm a nerd, I had to go down into the nerd weeds with my nerd calculator and say, what? Let's test this, Dan. You're putting this out there. What if the contribution went up by $1,000 and somebody missed that, but they only missed it for 1 year? Well, here's some hypotheticals. Okay. So assuming that the year that person missed it, they happened to be 30 and they found it the next year and fixed it. So they just missed that $1,000. That's no big deal, right? I'm not going to say it's a huge deal, but it's not insignificant. Because let's say that person was 30, and if we just assume, the C fund over its history has averaged 10.01%. And no, I'm not telling everybody to go in the C fund, put all your money in C fund. Want to be clear. No, don't do that. But that's been its average rate of return. So if somebody missed that $1,000 and we use the C fund's rate of return, take it out to when they're 65, that lowly $1,000 grows to $28,000. So again, I'm not saying that's a make or break, but what if that $1,000 had friends? What if there were multiple things missed? So I don't want to dwell on the misses because you can't fix what's behind you. But what I'm suggesting is that you introduce a proactive approach to not missing. I think in this day and age, we all have stuff on our digital calendars. Okay. Birthdays, anniversaries, vacations, everything. We managed to get that stuff on there. So I'm going to suggest that you get a couple of dates on there for a January jump. Okay. And the first will be to look up what the new amount is. So let's say December 1st You put this on your calendar, look up what the new TSP contribution amount is. And then somewhere around 24th, 25th, somewhere in there, so that you're on time for your first pay in January, put in the new numbers. So this is something called habit stacking. And it's super powerful. We all can do it, and we're already set up to do it. So just as you would put it in for your spouse's birthday, your kids' birthdays, your anniversary, put that in there to remind you. You already are used to setting reminders for yourself. So make one. So early December, check the new TSP contribution limits for both regular and catch-up if they apply. Then about mid-December, late December, set up those new contributions accordingly and make the annual adjustments routine. You know, Katelyn, have you experienced this? I have, where when we bring it to a person's attention that they're not contributing to the maximum, they're off by more than $500. They're off by thousands sometimes.
Oh, yeah.
And I think that's just a cumulative thing. I don't think anybody meant to have it turn out that way. So let's make it easy for it to turn out the other way. And benefits of the January jump, if I haven't made them clear enough, it ensures that you're always at that maximum, and it supports the financial planning principles of steady progress and habit formation. Because if you've listened for a while or watched for a while, you know I'm a big believer in that habits build wealth. Now, here's my favorite part of that article, because you know me, I'm always one to move people ahead. If you happen to not be at the maximum yet, don't tune me out. Read the article and see the suggestions that I have for building your own habit stack to help you build towards getting to the maximum. Okay, so small increases, maybe slightly higher than what the IRS said the annual increase was, can build you towards that. And we have seen this work time and time and time again. So, for example, just adding an additional $750 a year works out to $2,885 a paycheck. You know, and I'm not going to do the what that is in lattes. Everybody wants to do that.
Please don't. Yeah.
But that comes down to $14 and change per week. And the question becomes, would you miss $14 a week if it contributed to you having the great outcome in retirement that you want? So in conclusion, read about the January jump, do the January jump. Okay. This represents one straightforward, intentional habit that pretty much everybody can deploy across the board. One small step towards achieving those goals. Subscribe to League of Serving. Bookmark our website for reminders. A little plug here. The habit stacking. I learned that out of an article or out of a book called Atomic Habits from author James Clear's, one of our favorites here at the firm. His thought on it: all big things come from small beginnings. The seed of every habit is a single tiny decision. But as that decision is repeated, a habit sprouts and grows. Or as I like to say, baby steps work. That's why babies use them. So there you go.
Absolutely. Well said. Well said. I love it. January jump gives a January jump rope for a heart vibe that I love. So speaks to the
any way it works. Any way it works,
right?
I'm here for it.
Yeah. For sure. For sure. Well, we had another companion article that really I mentioned under our benefits bin column that really kind of dovetailed, I think, really well with Dan's piece on the January jump. This was all about Roth TSP and catch-up contributions for those who are over 50, or I should say 50 and older. So basically, we summarized some of these articles in the January jump piece, but for 2024, the standard contribution for TSP, if you are under 50, well, actually for everybody, is $23,000. However, if you are 50 or over, then you get to contribute what's called a catch-up contribution, which is an additional $7,500 on top of that $23,000 standard limit. So that would be a total of $30,500, just to kind of show off the math skills there.
Nice.
So obviously eligibility, you got to be 50 or older in order to make that additional $7,500 annual contribution. You got to be currently employed and in pay status. Obviously, this is not for our annuitants and for our retirees. And you need to have maxed out the standard annual elective deferral limit, of course, for the catch-up contributions. Now, I don't want to label the catch-up contributions as too independent of your regular standard contributions. They don't go into a separate bucket in the TSP. They don't get invested differently. All of it goes into kind of that one pot. But a benefit of doing these additional catch-up contributions when you turn 50, again, this is another date you should mark on your calendar. For the calendar year in which you turn 50, you start to be able to make these contributions. And they will allow you to turbocharge your retirement savings in your final working years. In that run up, a lot of our feds retire at 62 because that's when they can get their 1.1 times pension multiplier. In that run up to 62, 12 years of maxing your TSP plus the additional $7,500 catch-up contribution is huge when it comes to retirement savings. Another big benefit is it allows for compounding growth. So if you're adding more money to that TSP, then you're getting more compounding interest from those investments, because when you're adding to the TSP, you are also going in and investing that money. So this is going to boost your retirement savings significantly, even when you're looking at a short period of time. This is really helpful for folks who started saving later in life. Maybe, when you were younger, maybe you were saving to your TSP, but you were only contributing enough to get the match, right? Maybe you had a couple kids. When you have kids, money just vanishes. It's one of the wonders of the universe. It just sort of disappears into thin air.
Kids eat money.
Yeah. So it can be really hard in those early years when you've got a young family to max out the TSP. The catch-up contribution is a tool that you can use to kind of make up for that. And then also helpful for folks who have maybe been through a divorce. Maybe they lost some of their TSP pursuant to a divorce decree, or maybe, they had some competing priorities earlier in life and just couldn't maximize their contributions. So all good reasons to contributing to the catch-up. Now, you may be listening to this and saying, hey, Katelyn, I'm over 50 and I'm not doing catch-up contributions. How do I fix that? You can manage your contributions via election form TSP1 or TSPU-1 or via your agency's electronic system. So the system that you're logging in to get your pay stubs and to look at everything there, if you log in there, you can normally adjust those contributions. You can sometimes also, certain folks can adjust it on the TSP website, oftentimes for changing the tax profile of your contributions. So Roth option versus traditional, that'll be something you got to do on your agency's site. So just want to call that out. The contributions are automatically capped at your limit. So at $30,500, they will cut you off. They won't allow you to overfund your TSP. The only situation in which that's not true is if you maybe transferred into federal service during the course of that year, right? If you had a 401k at a private company prior to becoming a Fed, the TSP has no idea what you contributed to a prior 401k. And therefore, you could get a situation of overfunding. But if you are a Fed, have been a Fed for the entirety of the year, no worries on increasing that contribution. You can bump it up and they'll cut you off when you hit that limit. I do want to spend just a moment talking about Roth, particularly in the context of catch-up contributions. So Roth contributions, that's after-tax money that you're putting into your TSP. It grows tax-free, and you can also withdraw it in retirement tax-free if certain conditions are met. So this would be the account's been open for at least 5 years. You're at least 59 and a half when you make the withdrawal. My caveat there is that for TSP, you can have tax-free distributions as early as age 55, depending on your retirement date. So I just wanted to flag that. Obviously, with traditional, those are pre-tax contributions. So those are going to grow tax-free. When you pull them out of your TSP in retirement, they're going to be taxed as income at whatever your income tax rate is at the time that you're making those distributions. So just kind of a flyover for Roth money versus traditional money and the TSP and how those are taxed. So obviously, Roth contributions to the TSP can be advantageous, particularly at this period in time, because right now through the end of 2025, Tax Cuts and Jobs Act of 2016 is still in effect. That piece of legislation is set to sunset if new legislation is not passed on December 31st of 2025, and then we will revert back to our prior tax brackets. And if you remember, our prior tax brackets are pretty aggressive. The 22% bracket, I believe, is the 25% bracket, and the 24% bracket will become the 28% bracket. So stick with me here. If I can put money into my TSP now and I'm in the 24% bracket, I should do that, right?
Sure.
Notwithstanding other factors and financial context and your unique situation, which we always have to be concerned about. But if I can put money into a Roth TSP when my tax rate is 24%, as opposed to when my tax rate is 28%, that is advantageous for me, right? So it is a good time for many folks to be considering putting a little money towards the Roth option in your TSP just to build some tax flexibility for yourself in retirement. If you've got, I say this all the time, if you've got both traditional pre-tax money and Roth money, then you can be flexible as tax legislation changes, as tax rates go up, as tax rates go down. You can sort of be dynamic and flexible with your cash distribution strategy. And remember, your employer match is always, always, always going to go in the pre-tax bucket. So you're always going to have, if you're switching over to Roth option and you're worried about having pre-tax assets, your match is always going in on a pre-tax basis. So you will always have that bucket there. So I think maybe considering some Roth, if you haven't built up much of a Roth balance in your TSP, could be something to look into for many of our feds. But on the whole, definitely, as Dan mentioned in the January Jump article, stay on top of these maximum contribution limits. Set a reminder to check it every year. And if you are over 50, I would definitely go in, double check how much you're contributing to your TSP. Make sure you're taking full advantage of that catch-up contribution if it's something that you can manage right now, for sure.
Gotcha. That's awesome. Great, great article there. And folks, I think that's all the time we have for today.
All the time we have plus some.
Yes. This was definitely, that's my fault. This was definitely an ish day. Got really excited on my January Jump.
That's good info.
Be sure to come back next week and we will bring you the latest updates you need to know, make informed decisions about your career and financial well-being as a Fed.
Absolutely. And be sure to subscribe to our podcast on the YouTube channel, FedLife, so that you never miss an episode. We are also on Spotify. You can search us there under the Fed15 podcast. And please, please do remember to share it with your friends and colleagues. It really helps us boost the signal.
Gotcha. And for more information on the topics covered today and more, be sure to check out our blog at blog.stwserve.com and subscribe to our newsletter, The Weekly Serving, and you will get our latest delivered straight to you in your inbox every week.
Absolutely. And for those who want to dive even deeper into learning about your federal benefits and financial planning for feds, we encourage you to join us for one of our complimentary webinars. We talked a lot about TSP today, folks. If some of that or all of that went over your head, we have got a great session for you coming up on July 18th. We are doing our TSP planning webinar. It's going to be from 1 p.m. to 4 p.m. that day. I cannot encourage you enough to attend that webinar if you have not attended it before. There's so much that goes into the TSP. And if you've been curious about joining us for a webinar that maybe haven't known where to jump in, there's a lot of information. This is a great place to start. So TSP planning webinar on July 18th from 1 p.m. to 4 p.m. And we've also got a Social Security session coming up. Those are always popular with our feds. How Social Security impacts and factors into your plan as a Fed. That's going to be on July 24th from 11 a.m. to 12 p.m. And of course, if you are looking for financial planning help and you prefer a one-on-one approach, feel free to reach out to our team directly for a consultation at ask.stws@stwserve.com. We'll be happy to help you.
We absolutely will. So folks, thanks once again for listening to Fed15. I'm Dan Seid.
And I'm Katelyn Murray.
And we will see you next week.
See you there.